I told I've got 5 minutes, and 5 minutes you can't say this. So I'm going to keep things really simple, and I know things are much more complex than that. And I should declare an interest, as I will be joining in December the Royal Bank of Canada's European Subsidiary Board, and that's really important. So it's not the top-level bank. And I have spent a lot of time doing due diligence. They have 750 internal auditors looking at all those risks of those potential 25-year-olds, etc. And actually, I think the culture there is very good. But it has a very particular culture that's not necessarily shared across the rest of the city. I also have another sort of interest in that my son-in-law was in fixed income in UBS at the beginning of the week, and he no longer is.
Oh my.
And he's a baby arriving just after Christmas. But he's very confident he's going to get another job, so I hope he's right. But the really big question, as I actually put it really simply, it is, can a government allow a bank to fail? That was the question we were looking at the ICB, and the Independent Commission on Banking. And allied to that, indeed, are some banks too big to save? And in the UK, we are getting quite, we're getting quite close to that. In the day of there's meltdown, it is not at all clear that the UK could actually support banks in order to save them. And what we were doing with the ICB was trying to ensure that we got down the road of saying, what do you need to do in order to ensure that the government will allow a bank to fail? Now, some of that was about making banks simpler, which was about separating out the retail and the wholesale. Some of it was about ensuring that there was lots of capital to be absorbed if there were losses, and a variety of other sort of things along those lines. We knew we hadn't gone far enough, because there's no way, even if all those things were implemented today, that the government would allow a really big major bank to fail. So, and I think that is the big question we have to keep on asking, and to say, what do we still need to do to ensure that we can actually allow a big bank to fail? Because until you get that, you are not going to get bondholders being seriously activist if they think that they can get away with not losing money when a bank fails. You've got to get the incentives so that when a bank first of all can fail, if it takes big risks or it just is unlucky, it fails, and then the equity holders lose their money, but also the bondholders, and then the question mark of how much the depositors lose. And how, during that process, you ensure that the economy doesn't implode. And one of the reasons I joined the Payments Council, because I was really interested, because payments are one of the key, it ensures that the economy functions. And one of the things we are looking at is how do we ensure that if a major bank fails, that people can continue to use the ATMs, they can still get the salaries, they can continue to let the economy function. And that's a key thing you need to have in place before you can be sure that you can allow a bank to fail. So I agree completely about the debt holder issue, that you've got to ensure, I'm not sure, I'd like to make sure that if they have to face the music if something goes wrong, they are going to be more activists. They're going to care a lot more about what the bank's approach to risk is and the risks that they're taking. But what I really want to talk is bank governance. And one of the reasons I was put onto the ICB was because I had been the Director General of Ofgas, which was the gas industry's regulator, and we introduced competition into the gas industry, which the gas industry thought couldn't be done. And so I had to think really hard about the structural things we needed to do to ensure that competition could thrive. Now, there's lots of issues that are wrong with competition in the energy business, but I think we got some things right. But the key thing I fought for really hard was to get in the legislation that enabled us to get competition, enable competition to happen, was a duty to promote effective competition. Now, I fought really hard within the ICB, and actually John Vickers supported me, and we got it into very early into our recommendations that we would ask the government to introduce a duty on the financial services, the new FCA, to introduce their duty to promote effective competition. Now, it's not quite as clean as I would like, but it's there. And I think this is quite radical, and I'd just like to take a segue into safety, which may sound like it's a completely irrelevant subject, but believe me, it is actually very relevant, because in the early 90s, what used to happen is that the regulator would write the safety case. That meant when something went wrong, companies would say, excuse me, I followed all your rules. There may have been silly rules, but that wasn't my responsibility, it was yours, regulator. So you can't come back at me and complain that this safety regime failed, because it's your responsibility, not mine. If you've got, and when they changed that, and it was a very bold decision to do that, what they did is say, no, we're no longer going to write this, we're going to tear up all our rules, you, board, are going to be responsible for the safety regime in your company. If it goes wrong, you might go to jail, you certainly might get fined, but whatever happens, it's your responsibility. So you have to think through what all the risks are, where they lie, how you can mitigate them, how you can ensure that you are covering them. And as it was said earlier, I'm now chairman of Magnox. Magnox is a nuclear business. And I had an interview the other day with somebody who's looking at how boards function. And I just brought up that we happened to have a long conversation at the board about a dropped spanner. They said, how can you have a long conversation about a dropped spanner? I said, it's really important that we did that because it's all about the culture in the organisation that allowed, it was actually a dropped spanner that fell into an area where people were working 70 feet below. Somebody could have died. So actually it was an important issue. And we take that really seriously in all the businesses I'm involved in where safety is key. And this safety regulator is kind of irrelevant because if we take pride in doing what we need to do safety well, I think people come to work wanting to do the right thing. Because we have the responsibility, we take that responsibility, and the safety regulator can just sit there quietly watching what we do, being a bit of a policeman occasionally, challenging us. But essentially, it's our responsibility, and it works really well because safety is embedded into the culture of the board. So how do you do that in the financial sector? Well, what you don't do is write reams and reams of rules and regulations and guidance. So the whole purpose of this duty to promote effective competition is to say, I, the regulator, will no longer write any rules for you. I'm going to give you the responsibility to treat customers fairly, by which I mean that if I see that things are happening in the world which wouldn't occur if we had a good functioning competitive market, then I know something's wrong. So is what's wrong structural? Maybe ring fencing won't work. Is it because the information flows, customers aren't being told what the facts, and then, or they're being told in such a complex way that you can't understand what's going on, or you're discriminating against certain customers. The PPI was discrimination, overdrafts are discrimination. Our bank's trying to find ways to basically take on some customers who are not going to either understand or have no choice but to be overcharged. So you could, and the reason is way back when in 1998, when I was just coming out of finishing being the regulator of the gas industry, PPIs were already clearly being missold. And I couldn't understand why the FSA didn't tackle this because they had competition duties. In 2001, there was a super complaint from the Consumers Association. So this is clearly a big issue. It's been a big issue for decades. All the regulator had to say then, back in 1998, is PPI has nothing wrong with the product. What's wrong with who you're selling it to. You're selling it to some people who clearly could never use it. So clearly you're discriminating against them because you're charging for something they could never actually use. And the duty is on you companies, not on the regulator to explain what you're doing. It's for you, the company, to explain to me, the regulator, why what you're doing is not discriminatory and why it's okay. And I'm not going to tell you what the rules are. You've got to explain to me why this is okay. And so, as far as I was concerned, this thing should have never, should have been hammered in 1998, not being allowed to be a big issue all this time forward. You can do the same thing with wholesale markets. If you see things are not working, if there's a cartel or things are not properly competitive, you've got all the things you need in order to stop bad behaviour with that duty. It's incredibly powerful. But it's never been used in the financial sector anywhere in the world, so people think it can't be done. It had never been used anywhere in the world in energy when I did what I did. So, so just because it's never been done anywhere in the world, it's not a reason why it can't happen. It may sound very simplistic, but I just think you could change regulation quite radically and force boards, therefore, to take responsibility for their own actions and not allow the regulator to take on all the load of what happens.
I see we need to talk about regulation as much and the regulators as much as we're going to talk about the board.
Yes, I think you get the boards that reflect the regulation, actually.
Yeah.